Death may strike anyone prematurely. When death takes the life of a family provider, surviving family members often survive if they are left without adequate income or the means of providing even basic necessities. Life insurance creates instant estate regardless of when death occurs. However, some people face the unpleasant prospect of outliving their income. Retirement may be forced upon them before they have adequate prepared for a non-income earning existence. Sickness and disability can also be economic scars, often more intense than death. Insurance evolves to produce a practical solution to economic uncertainties and losses. The primary reason for purchasing life insurance is to provide death benefits. However, insurance income during a disability, annuities provide income by making a series of payments to annuities for specific of period of time for life. Reserves. Reserves are the accounting measurements of insured future obligations to its policyholders. There are classified as liability on the insurance company's accounting statements, since they must be settled at a future date. Liquidity indicates a company's ability to make unpredictable payouts to policyholders. Types of insurance companies. There are many ways to classify organizations that provide insurance. In the broadest of terms, there are two classifications: private, commercial, and government. Within these two classifications, there are many categories of insurance provided, as well as insurance plans and insurance products. Private insurance companies. Commercial insurers offer many lines of insurers. Some sell primary life insurance and annuities, while others sell accident and health insurance or property and casualty insurance. Companies that sell more than one line of insurance are known as multi-line insurers. Stock companies. Non-participating. A stock insurance company is private organization organized and incorporated under state law for the purpose of making profit for its stockholders/shareholders. It is structured in the same way as any corporation. Stockholders may or may not be policyholders. When declared stock dividends are paid to stockholders in a stock company, the directors and officers are responsible to the stockholders. A stock company is referred to as non-participating company because policies do not participate in dividends resulting from stock ownership. Mutual participating. Mutual insurance companies are also organized and incorporated under state law because they have no stockholders. Instead, the owners are the policyholders. Anyone purchasing any insurance from a mutual insurer is both a customer and owner. He has the right to vote for members of the board of directors by issuing participating policies that pay policy dividends. Mutual insurers allow their policyholders to share in any company earnings divisible surplus. Essentially, policy dividends represent a refund of the portion of the premium that remains after the company has set aside the necessary reserves and has made deductions for claims and expenses. Policy dividends can also include a share in the company's investment. Mortality and operating profits. Surpluses are typically distributed to policy owners on an annual basis. Mutual companies are sometimes referred to as participating companies because the policy owners participate in dividends. Occasionally, a stock company may be converted into a mutual company through a process called mutilation. Likewise, mutiles can convert to stock companies through a process called demutilation. Stock and mutual companies are often referred to as commercial insurers. They both can write life, health, property, and casualty insurance. Assessed mutual insurers. Assessed mutual companies are classified by the way in which they change premiums. A pure assessment mutual company operates on the basis of loss sharing by group members. No premium is paid in advance. Instead, each member is assessed an individual portion of loss that actually occurred. In advance premium assessment, mutual charge a premium at the beginning of the policy period. If the original premium exceeds the operating expense and losses, the surplus is returned to the policyholder as dividends. However, if total premiums are not enough to meet losses, additional assessments are levied against the members. Normally, the amount of the assessed that may be levied is limited either by state law or simply as a provision in the insurer by law. Reciprocal insurers. Similar to mutual, reciprocal insurers are organized on the basis of ownership by their policyholders. However, The reciprocals is the policyholders themselves who insure the risk of the other policyholders. Each policyholder assumes a share of the risk brought to the company by others. Reciprocals are managed by an attorney in fact, Lloyd's of London. Contrary to belief, Lloyd's of London is not an insurance, but rather a syndicate of individual companies that individuals underwrite insurance. Lloyd's can be compared to the New York Stock Exchange, which provides an arena and facility for buying and selling public stock. Lloyd's functions is to gather and disseminate underwriting information, helping its associates settle claims and disputes, and through its members, underwriters providing coverage that might otherwise be unavailable in certain areas. Reinsurers. Reinsurers is a specialized branch of the insurance industry because they insure insurers. Insurers is an arrangement by which an insurance company transfers a portion of a risk and it has assumed to another insurer. Usually, reinsurers take place to limit the loss of one insurer would face should a very large claim become payable. Another reason for reinsurance is to enable a company to meet certain obligations such as favorable underwriting or mortality results. The company transferring the risk is called ceding company. The company assuming the risk is the reinsurer. A common reinsurance contract between two insurance companies is called treaty reinsurance, which involves an automatic sharing of risks assumed. In reinsurance agreement, the insurance company that transfers its losses exposed to another insurer is called the primary insurer. Captive insurer, an insurer established and owned by a parent firm for the purpose of insuring the parent firm loss exposure is known as a captive insurer. Risk retention group. A risk retention group, RRG, is a mutual insurance company formed to insure people in the same business, occupation, or professional, e.g., pharmaceuticals, dentists, or engineers. Insurance is also issued by fraternal benefit societies, which have existed in the United States for more than a century. Fraternal societies, noted primarily for their social charitables and benevolent activities, have memberships based on religious, national, or ethnic lines. Fraternal first began offering insurance to meet the needs of the poorest members, funding the benefits on pure assessed base. Today, a few fraternals rely on assessment system, most having adapted the same advanced funding appropriate to other insurers used. To be characterized as a fraternal benefit society, the organization must be non-profit and be have a lodge system that indicates ritualistic work and maintain a representative form of government with elected officials. Fraternals must be formed for reasons other than obtaining insurance. Most fraternals today issue groups of annuities with many of the same provisions found in policy issues by commercial insurers. Industrial insurer. Insurer is also sold through a special branch of industrial known as home service that insures. These companies specialize in a particular type of insurance called industrial insurance, which is characterized by relatively small face amounts, usually $1,000 to $2,000, with premiums paid weekly. Service providers. Service providers are often benefit to subscribers in return for the payment of premiums. Benefits are in the form of services provided by hospitals, physicians participating in the plan. They sell medical hospital care services, not insurance. These services are packaged into various plans, and those who purchase these plans are known as subscribers. Another type of service provider is the Health Maintenance Organization, HMO. HMOs offer a wide range of healthcare service to member subscribers for a fixed period premium paid in advance of any treatment. Subscribers are entitled to the service of certain physicians, hospitals contracted to work with the HMOs. Unlike commercial insurers, HMOs provide financial health care plus the health care itself. HMOs are known for stressing preventive health care and early treatment programs. The third type of services provided is Preferred Provider Organization, PPO. Under the usual PPO agreement, a group desired health care service, e.g., an employer or a union, will obtain a price or a special service from a certain healthcare provider in exchange for referring its employees or members.